Hello students, this is investment management class and I'm Sheetal ma'am. This is my first video on investment management. Sorry for the inconvenience because of this is a new subject and books are not available. I was unable to take the videos. Now onwards I'll be sending you all my own videos and sometimes I'll be taking class through Zoom app. Okay, so first let us start with the first part of your syllabus. So first is investment environment. So before telling the main bookish work, I will tell you in general investment means what. Investment means if we are having money, if you're having spare money or extra money, or if we are thinking of future, you can say safety, what we do, we try to invest our money, or we try to put our money in some useful sources through which we will get in return. In return means what? In future, if you're investing, say for example 5,000 rupees today, next after 4 5 years this 5,000 you will get as 50,000. So you can say increasing the wealth, increasing our property. It may be increasing our money, increasing our fund. All this is nothing but investment. So investment, we know where to invest. Okay, so you all must have clear with the word investment. So investment means what? Putting money in some effective resource. Okay, effective resource through which we will get return. Effective resource means in return you will get some money. In return you will get some extra money, or in return you will get some extra profit. You will get some extra dividend. So these are the investments. So investment management subject, what we study is nothing but total structure of investment. How to invest, where to invest, what are the method of investment, what is the process of investment, then what decision we should take, how many methods are there of investing, which is useful for us, which is not useful for us, what is the risk of investment, what is portfolio investment. All these things we will be studying in this subject. Okay, so completely this is your investment environment which we are going to study. So investment environment I've written here, it includes all type of investment opportunities and the market structure that facilitates buying and selling of these investment. Okay, all types of investment opportunities. It may be your banks, it may be private companies, it may be government companies, it may be shares, bonds, insurance companies, post office. Wherever you invest, all those are known as investment opportunities. And the market structure, the structure of the market which facilitates, what it facilitates buying and selling of the investment. Okay, so you can invest anywhere which you is suitable for you, which is less risky, which is giving more return, which is giving more money, we invest there. So environment is nothing but all the structure of investment, where say for example banking sector, private companies, government companies, insurance companies, then it is your share market, anywhere you investment, all that includes is in the investment environment. Okay, different types of securities, institutional setups, market intermediates are the components of environment, investment environment. So different types of securities. Securities means shares, bonds, NSE certificates, insurance, all these are securities. Then institutional setup, it may be a stock exchange market, it may be a private companies, your government companies which you are going to invest. Market intermediaries means in between some brokers are there, agents are there through which you all will invest money. So all this is nothing but part of your investment environment. So hope you all have understood the meaning of investment environment. So next part in your syllabus is straight away investment decision process. So as you know, what is investment? We invest money, we put investment in one some effective resource through which we are earning something in return. Okay, so how to do that? What is the process of investment? First we should know before investment. So investment decision process. Okay, if you are having money, say for example I'm having 50,000 money, and this 50,000 money I want to invest, but straight away I will not invest in anything. First I have to study where to invest. If I invest in insurance, how much return I will get? If I invest in bank, how much return they will give me? How much profit I'll be earning? How much risk is there in that? This everything I will first study, and then only which is suitable I invest. So first one is investment decision process relates to the decision made by the investor. Investor means we, or management, with respect to the amount of fund to be deployed in the investment opportunity. Develop means to invest, to put. Okay, so first step of investment process is what? Determining investing objectives. Okay, so your first step of process is what? Determining investing objective means, determining means searching. Okay, searching, selecting investing objectives. First I should determine my objectives. What is my objectives? I have money and I want to invest. This is my objectives. But what type of objective I should have? Only investing should not be my objectives. The objective should have one reason behind that. Say for example, you want money for the education of your children, you want money for retirement life, or you want money for your safety in future. So in this way, when you are determining investment objective, means you should have objectives of investing. Not only you are having money so you should not invest, you should have an objective for investing the money. As I told an example, if the parents want money for children education after 10 years. So after 10 years they want money for children education. So now before 10 years what they are doing? They are trying to invest money in some useful resources which will give them a huge amount after 10 years. Okay. So this is my objectives. Say for example, for child's marriage I have kept the fund. So it may be my fixed deposit. I may keep the fund in the bank as fixed deposit. I may do RD in the bank. I may purchase some shares of a private company, or I may purchase shares of business. Say, for example, I may purchase shares of government companies. So, in return, I will get some profit. Okay. So, every investment should have an objectives. Okay. Not only simply should not be invested, it should have an objective behind that. It may be for any reason. Objective is what? You should give a reason why you are investing money. So you'll have to tell the reason that it is for my children's education, it is my children's future, it is for my children's marriage, it is for my future retirement life, so it is for constructing a house. So in this way you should have reason for investing. Okay, then only which is suitable investment they will tell you, and in that particular investment you can invest your money. Okay, first is always should have a objectives. Okay, next is developing an investment plan. Developing an investment plan means what? You should have a plan. Anything. Say, for example, if you are going to have exam for after 1 month, then you will plan for that. Which subject I should study? You will prepare a timetable for that. So, which is a subject which is difficult, I should study more. Which is a subject which is not difficult, which I'll study less. So, in this, you will plan for that. Same way, before investing, all the investors should develop an investment plan. So, what is that plan? He should see how much money he is having, how much money he can invest. Then that money, if I am investing in some resource, how much money or how much return I will get, what is my budget, what is the risk tolerance which I am having. So if in case you have not on if you have invested money and in return instead of earning money you have incurred a loss, so if there is a loss of 50,000, whether you can overcome that loss, how much tolerance you are having to overcome the risk. So you should first plan your period for how many years you want to invest. Then you should plan the risk tolerance, till how much you can take a risk, how much limit you are having of taking a risk, how much money you are having. And specify what type of risk you are ready to take, whether you want to increase your wealth, or whether you only want to increase money, or you have to have a liquidity process. Everything you should be clear before investing. So second, you should always plan what type of investment you want to do, how much money you are having to invest, then for what period you will invest, then how much risk you are ready to take. All this you should be preparing in the second process or second step of your investment decision process. And third is evaluating and selecting investment alternatives. So evaluating and selecting alternatives means, once you have decided how much money to invest, once you have decided what is the complete plan of investment, next you start evaluating and selecting the investment alternatives. So in the market, in investment market, many sources are there through which you can invest your money. There are hundred of sources which you can invest. There are banks are there, insurance companies are there, mutual funds are there, stocks are there, shares are there, bonds are there, then it may be some scheme is there. anything, many resources are there through which you can invest. So for that, you should select your investment alternative, whether you want to invest in banks, whether you want to invest in share market. You should be clear about that. Okay, so in this third process, you should start evaluating. If you are investing, say for example, in a share market, how much return I will get, what will be the dividend paid by the private companies, what will be the dividend paid by the government companies. But in case I'm not ready to take more risk, I will deposit my money as fixed deposit in banks. Okay, so if I'm depositing my money in the bank as fixed deposit, how much interest they are paying, all this you'll start evaluating. You will start studying about that, selecting. After you have studied, what you do, you select one option. You may select bank, you may select insurance, you may select shares, bonds, depends upon your convenience. Okay, this is your third step. Then fourth is constructing a portfolio. So constructing a portfolio means what? A group or an arrangement of, you can say, in simple language means portfolio is a range of different investments. Okay, range of different investment. Range means what? Again, many types of investment are there: shares, stocks, debentures. So you don't want to, say for example, you don't want to invest only in one area. You want to invest in 2 3 different areas. Some amount, say 50,000, you want to invest in bank, 20,000 you want to invest in shares, again remaining 40,000 you want to invest in bonds. Depending upon your convenience, you have decided a portfolio. So that is known as portfolio. Structure of your investment or your range of investment, which all investment or group you have to prepare. Say group of what? Group of investments. So group means in a group, first may come bond, second in shares, third in bank, and fourth in insurance. In this way, four options you are having where you are going to invest. This all the four options together is known as portfolio. Okay, so you have to construct your own portfolio. Then comes last step, evaluating and revising the portfolio. So once you have decided that yes, I will invest in bank 10,000, I will invest in insurance 20,000, I will invest in shares 40,000. In this way, after selecting, after constructing a portfolio, you try to evaluate, revising the portfolio. So evaluation means what? You will have written a answer sheet, you will have written a question answers in on paper, and I will take that answer sheet and I will try to correct all the corrections or do correction. That is known as evaluation. Okay, so evaluation, again what you'll have to do is, when you'll have prepared the portfolio, up you have to be updated, and all the times you should try to evaluate that. Why evaluation? Because market is not same all the time, it changes every day. So today if you have invested in banks, tomorrow that same bank may not give you more interest, you may go in loss. Otherwise, instead of banks, if you have invested in shares of a private company, that share may give you more money, okay, in return. So what happens, sometimes whatever we have planned, it may fail. So what we do, always we try to evaluate. If we have failed in one portfolio, we try to prepare one more new portfolio. Okay, we have to revise it. If I am not getting any money in banking sector, I shift my money to insurance sector. Or if I am not getting money in insurance sector also, I may invest my money in shares. So in this way, you should try to evaluate and revise your portfolio. Okay, so this is regarding investment decision process. So these are the 5 steps which you should know. First, always determine investment objectives, develop investment plan, then evaluate your plan, then construct a portfolio, and then evaluate the rising portfolio. Okay, this is your investment decision process. After this, you are having types of investment. So here I have written different types of